Hi, this is Mark DiOrio, Chief Investment Officer of Brookstone Capital Management. This is the fourth quarter market outlook. Last week's call discussed October volatility. Seasonal volatility for October is normal, and keep in mind it can rip both ways. I would not extrapolate recent market activity into the beginning of a long-term bear market. Those coincide with recessions. But because volatility has been so low for the most part of 2 years, it may feel worse than it is. The Fed's rhetoric about raising interest rates spooked the market, and in a combination with seasonal volatility, the move is probably a little more exaggerated than conditions would dictate. There's a little bit of a calendar-based liquidity squeeze because global debt maturities happen to be larger than usual at the moment, while the Fed is no longer buying treasuries, and corporations cannot buy back stock due to the blackout period before earnings announcements. Now moving on to the market outlook. Despite all the anxiety over the 10-year Treasury rate rising above 3%, it is about where it was in June 2011. The major difference is short-term rates have risen considerably. Traditional economics would argue that rising interest rates would slow consumer spending, slowing down the economy. However, we estimate there is about $10 trillion in savings, money market, and CD accounts that are going from near zero interest rate to earning 2% interest, creating an extra $200 billion in discretionary income for consumers next year. The economy usually doesn't run into a pending recession until unemployment claims start rising. That's not the case. The unemployment rate just hit a cyclical low at 3.7% and looks like it is heading lower. The combination of full employment and additional discretionary income from higher interest payments is likely to keep the consumer pushing the economy in the right direction. It's a rare negative year for bonds. It will only be the fourth year since 1976 that the aggregate bond index has posted a negative return. However, that's a short-term discomfort. Future bond returns are based on starting yields. The 5-year rates are at their highest points on both a nominal and real yield basis in the last decade. In brief, future bond returns look brighter. Despite any short-term volatility since 1950, in every year that followed a midterm election year, stocks have posted a positive return. In 76% of those cases, stocks saw a double-digit annual return. Diversification has been out of favor this year. The anomaly has been U.S. stocks are higher, while almost every other major asset class is lower on the year. While the media may quote the Dow Jones Industrial Average, keep in mind that is comprised of just 30 U.S. large-cap stocks, and 3 stocks make up nearly 25% of the entire index: Boeing, United Healthcare, and Apple. Those 3 stocks have performed well this year, leading the Dow higher. If the reverse happens, those 3 stocks could lead the Dow lower. The point is that sometimes commonly referred to indications of the market, such as the Dow, are not very reflective of how a diversified portfolio is performing. The benefits of diversification are well documented academically and are the standard for prudent capital allocation. We diversify among multiple asset classes and strategies because after studying the academic material, we think it is the most sensible and time-tested approach to reach individual investor goals. By remaining diversified and blending multiple asset classes together in a portfolio, an investor's outcome is not subject to the highs and lows of a single asset class. It can be hard to be disciplined and remain diversified, but today's underperformer could be tomorrow's outperformer. In the short term, a diversified investor is always lagging whichever market or asset class is leading. This has been the fourth quarter market outlook.